Nvidia's stock price soared in 2023. Starting at $146.14 per share on December 30, 2022, it began its ascent following the breakthrough in machine learning and resulting artificial intelligence hype. By year-end, the share price had more than tripled to $495.22, only to be eclipsed by an even sharper rise over the next 3 months. By March 15, 2024, Nvidia's stock price reached a historical peak of $942.89. With 2.5 billion shares outstanding, Nvidia's market valuation exceeded $2.3 trillion, aligning it with tech behemoths like Microsoft and Apple as one of the largest companies by market capitalization. Nvidia's CEO Jensen Huang is clearly enjoying his company's explosive success, as he frequently appears in public places, sharing ideas from insights into a future with artificial intelligence to advances to younger generations. It's hard to believe that just a few years ago, Nvidia was primarily known for its association with video gaming. Today, it leads the artificial intelligence hardware market with seemingly unlimited potential. During this period of high optimism, investors would be wise to err on the side of caution. Nvidia's stock price has likely surpassed even the company's own expectations. In our opinion, Nvidia's stock has grown excessively overvalued, with a major market correction bound to happen sometime soon. Despite Nvidia's best financial year in 2023 with a net income of $29.76 billion and a profit margin of 48%, it remains far from the $92 billion net income required to sustain its current valuation under 4% inflation. Historically, Nvidia's net income has typically been below $5 billion, never surpassing $10 billion. To justify its current stock price, Nvidia would need to triple its net income within 5 years, which is a highly optimistic scenario. Nvidia's financial success in 2023 was driven by a global GPU supply shortage and its market leadership, which will not last indefinitely in the future. Competitors like AMD, Intel, and Google will challenge Nvidia in artificial intelligence hardware innovation. The possibility of a disruptive new product from these competitors could significantly impact Nvidia's market position. Buying the Nvidia stock now is almost the same as betting on Nvidia will beat all the competitors. Another dimension in the analysis of Nvidia as a company is through comparison with Cisco's success in the 1990s. Nvidia and Cisco are very similar in that both are hardware companies, and both enjoyed tremendous success in the beginning of a new tech era. For Cisco, the opportunity came when Internet was introduced to common household and soon became popular. Cisco manufactured switches and routers which were needed everywhere that required Internet connection. As the Internet business boomed, Cisco made a lot of money and its stock price went from 8 cents per share in 1990 to $80 per share in 2000. At its most glorious moment, Cisco was trading at 150 to 175 price-to-equity ratio. After reaching the peak in late March 2000, Cisco started to drop fast. Within 1 year, it had lost 85% of its value. To the present day, after 24 years, Cisco's stock never recovered from the crash. One thing is worth pointing out: even though Cisco's stock went bust, Cisco as a company carried on. Cisco is still a profitable company that makes tens of billions of dollars every year, with a strong brand and sound business operation. It's only the Cisco stock price that failed to revive. This story should teach investors two things. Firstly, a stock trading at very high PE ratio is bound for drastic future correction. In the case of Cisco, the correction came almost as soon as it hit the peak, and annihilated $464.1 billion investors' dollars in the process. Secondly, as a hardware company, Cisco's profit ceiling is bottlenecked by its capacity to manufacture and sell products. By comparison, a software company can scale its business much faster. In the early days of Internet, Cisco thrived by satisfying a growing demand for the essential infrastructure. Once the infrastructure is built, the focus shifted from infrastructure to application layer and from hardware to software. As software companies figured out how to monetize, their businesses recovered from the dot-com bubble burst and soon rallied next stock market bull run. While hardware companies like Cisco are largely forgotten, Nvidia's future can be a slight variation of Cisco's past. Recently, some worrying news surfaced concerning Nvidia's business management. In December 2023, Nvidia's CEO stepped up to address a problem with complacent workers. Since Nvidia's stock had gone up so much, many long-tenured employees were suddenly financially well off enough to retire. Some middle managers were reported to have entered a semi-retirement stage, where they showed little motivation to perform at work. Nvidia's product quality was also under scrutiny. RTX 4090, the most expensive consumer GPU Nvidia has released to date, still has serious safety issues like melting power cords. The problem still exists today, 2 years after the customers complained about them. This suggests a lack of commitment from Nvidia to addressing critical product issues and reflects poorly on Nvidia's customer service and product standards. While speculative market forces might temporarily boost Nvidia's stock price, its massive valuation makes significant future growth unlikely. At its current net income, a more realistic valuation for Nvidia would be around $767 billion, bringing the intrinsic stock price closer to $300 rather than $900. The future is not all gloom. Nvidia still has a substantial edge over its competitors. Bolstered by its respected brand value and market leadership, its proprietary computing framework, CUDA, is a unique asset that competitors lack and may take years to replicate. If Nvidia strategically leverages these advantages, it could potentially navigate through and even mitigate the anticipated stock price correction. However, should the company become complacent, it risks repeating the story of Cisco.